Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Zwan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to keep the episode short enough that you can listen to them when you need a bit of a break from work. Our topic for today is share incentive schemes. Now, I think when we speak about share incentive schemes, what I've realized over the years is that you find them in large organizations, you find them in smaller organizations, and there's many different variations of them. But if you really look at it, the same underlying questions always arise in relation to these schemes. So our focus for today and the question I'm going to try to address is, what are some of the aspects that you need to look out for from a tax perspective when you are dealing with a share incentive scheme? Now, unfortunately, there's a bit too much to this topic to just cover this during your coffee break, but I've decided to talk about 3 T's relating to these schemes. The first one is the timing, the second one is the type of scheme, and the last one is trusts. So I'll go into each one in a bit more detail. If we start with timing, I think before we go into timing, it's necessary to maybe just recap again what Section 8C of the Income Tax Act is all about. So what 8C essentially says is, if an employee receives an equity instrument where there's, as a result of his or her employment, and that's to put it very broadly, the provision goes a lot wider than that to say if it's as a result of employment or by virtue of employment, you're within the scope of 8C. If it's, for example, that you are a director of the company, then you could be within the scope of Section 8C. If you've obtained the equity instruments through an arrangement that your employer has got with another person, you could be within the scope of Section 8C. And also the instruments covered by 8C is not only a share, for example, it includes share options and any rights that derive their value from shares. So if, for example, we're looking at a share incentive trust, which is often the vehicle that employers use to hold the shares, that they don't have to keep on changing ownership of the shares around every time someone goes into the scheme or goes out of the scheme. But so in that case, the employee would have a right to the shares in the scheme as, for example, a beneficiary of that trust. So that right, because it derives its value from the shares of the employer, would also be within the scope of Section 8C. So 8C is quite a wide provision, and what it does is to say that if you've got a share that is within the scope of this provision, the employee will be taxed on the market value of that share as income when the person disposes of the share or when the share vests in the employee. So essentially, the share is taxed as remuneration for the employee. Now, the critical aspect of 8C, to go back to our first T relating to timing, is the whole concept of vesting. Now, if you look at when the taxpayer would prefer to be taxed, it's probably sooner rather than later. So because a lot of these instruments would increase in value the longer time goes on. So if you look, for example, at an option to buy a share at today's price, that option doesn't have much value. But if the incentive works and it incentivizes the employees, the key staff, to act in a way that increases the value of the company shares, this option will start getting more and more value, or even a share for that matter. If the share price increases as a result of management's objectives being aligned with those of the company, the longer you go on, hopefully the higher the value of the share would be. So as a general rule, it's quite favorable for the employee to be taxed as soon as possible. For the fiscus, on the other hand, you need to make sure that the person is taxed once they've really earned the value and not before that. So that's where the concept of vesting then comes in to govern this. And how 8C governs this is by having a distinction between restricted and unrestricted shares. So to determine whether a share is restricted or not, Section 8C has got a definition of restricted instruments, and that definition basically lists a few characteristics of the award that was made to the employee, to say that if these things are present, the equity instrument that you've received is not yet it's still restricted, so it's not yet vested. And vesting only happens for a restricted instrument once the instrument is no longer restricted. Now, I think that hopefully points towards the fact that when you structure a scheme like this definition of restricted equity instruments is very critical to make sure that if you look at the terms of the instrument and, for example, the agreements that you use to give effect to the scheme, that you know whether any of those terms or provisions of these agreements would cause the instrument to be restricted, because that's got a direct impact on when it is taxed and, in all likelihood, on what value the person would be taxed. Right, if we look at the second T, the type of scheme. Now, if we think about accounting, and those of you who are accountants would know that IFRS 2 is the standard that deals with share-based payment transactions. And that standard distinguishes between cash-settled share-based payments and equity-settled share-based payments. Now, tax doesn't have this distinction, but there are some areas where, if you look at this distinction from an accounting perspective, tax is likely to also have a different treatment for those two types of schemes. So as a general rule, something that is equity settled under IFRS 2 is very likely to fall under Section 8C. Something which is cash settled is very likely to be within the realms of normal remuneration. It's a cash payment that the employer needs to make, and the value is just linked to the share price. It's also very likely that this payment could be variable remuneration, to which Section 7B applies. The second effect of the type of scheme goes to the effect for the employer. Now, on all these payments, the employer needs to withhold employees' tax. Now, if you're settling in shares and the award is subject to Section 8C, then the employer needs to obtain a directive to determine how much tax to withhold and when to withhold the tax. If it's not an 8C instrument, the employer doesn't necessarily need that directive. The last aspect that's also a difference between the two and that affects the employer is the deductibility of the related expense. Now, if you look at it from the employer side, a few years ago there was a case, the Labatt Africa case, where the Supreme Court of Appeal concluded that if a company issues its own shares, the company doesn't actually incur expenditure, and it would not satisfy the requirements of Section 11A. So if the employer settles an award by issuing its own shares, it's not entitled to a deduction for that expense. If, on the other hand, the employer pays by cash, then it should be entitled to a deduction. So it does have actual expenditure incurred, but something like Section 7B could possibly still come into play to determine when the deduction can be claimed. And then the last one, the last T, is trusts. So the specific scenario I would like to talk about here deals with family trusts. So the situation would be the employee works for the employer offers the employee an incentive or a share incentive, and the two of them arrange that this incentive, the shares, will be granted to the family trust rather than to the employee. And in this way, the employee can start building up some wealth outside of his own hands. I think it's important to say that what I'm not talking about here is these trusts that I've mentioned earlier, the employer incentive trusts, where the trust is really used to manage and administer the scheme. The interest in that trust, as I've already mentioned, is likely to be an 8C instrument itself. So back to the scenario about the employee and the family trust. There's two important things here. The first one is that the employee would still be taxed on the value of the award or the shares. So I think that's to be expected. That's also in line with, if you look at, for example, paragraph C of the definition of gross income. If you do the work, someone else receives the amount, the employee would still be taxed on the amount. The part that catches a lot of people off guard is that if the shares go to a person other than the employee, what really happens in the background is that the employee is busy moving some value to that other person without consideration. So what is also triggered if the shares vest in, for example, the family trust rather than the hands of the employee, is a deemed donation. And this deemed donation has got donations tax implications. So a lot of people miss this one. Right, so in closing, we've spoken about the 3 T's that you are likely to encounter questions about. Hopefully what you've also realized during this quick talk is that these schemes are complex, and they could be complex for tax reasons or for non-tax reasons. But there are some basic rules that apply to all of them, and I've tried to cover some of the most critical basic rules in this episode. So that's all for today. Thank you for listening. And if you've enjoyed the episode, please subscribe on your podcast platform and tell all your friends and colleagues about this podcast. If you've got questions you would like me to discuss in future episodes, my email address is in the show notes. You're welcome to send me an email to have a look at what you would like to hear. And just a reminder, as always, nothing in this episode should be construed as tax advice or even a replacement for fact-specific tax advice. Until next time, goodbye.